A really important part of this topic is inventory cards. In fact, you're going to record all the transactions of inventory in these cards. So we introduced it earlier, as we said, look, it's part of what's called the perpetual inventory system. We said it's the second feature. And what that means is the firm uses inventory cards to record the continual movements of its inventory. So what was it? It's a subsidiary record used to record all the transactions involving the movement of a particular line of inventory. So we can see here we've got an inventory item called the iPhone 13. Let's pretend we're JB Hi-Fi and we're selling these. We can see where it's located and so on. And yeah, it tells us the balance of the inventory, how many we should have. It tells us how many come into the business and how many come out of the business. And it's really important because it's going to be able to help us run a better business and also serve our customers better. So just to look at the different sections, at the top we'll see the inventory item, iPhone 13. On the computer, every item needs a code. Every item of inventory should have a code here. Location, so where will we find it, particularly if it's a big shop like JB Hi-Fi, which will get all its stuff from a warehouse. It's in aisle 2, shelf 8, and the supplier in this case is Apple. What else have we got there? We've got the details section where we have the date of each transaction and also the source document, or it might say balance, which we'll learn more about that as we fill these in. But we can see we should be able to match up these transactions to this receipt number, that invoice, etc. We've got the in column records all inventory coming into the business, and that's mostly going to be purchases. We bought 10 iPhones for $280 each from Apple, but there are actually other ways inventory can come in, but we'll deal with that later. The out column, that's mostly going to be sales. That's how inventory mostly leaves a business. So we can see a sale here of 1 iPhone and then a sale here of 2. But yeah, we won't do, there's going to be other things that make inventory come out as well. And lastly, we've got the balance column. It just tells us how much inventory is left. So in this case, we should have 5 and 10. That's 15. Just looking at that though, like within each section, we can see there's 3 numbers. QTY, what does that mean? That means the quantity. The cost, well, that's the cost price. That's not the price the customer pays. That's the price the business pays. And then we got the total, which is simply the quantity multiplied by the cost. So looking at this particular little, extraction of the stock card here, it says we've got 5 units. That's the quantity. They cost us $300 each, and that equals a total of $1,500. And we've also got 10 units of inventory, which cost us $280 each, and they equal $2,800 worth of inventory. So that's what those numbers mean. There will also be an inventory card for every different type of inventory. So let's say we're JB Hi-Fi, we'll have one for the iPhone 13. We'll have an inventory card for the Samsung Galaxy S22. We'll have an inventory card for the Huawei P50 Pro, etc. But it actually breaks it down further than that, because within each of these, there's sort of different models or styles. So every different model in a range will have its own inventory card. So if we go to the iPhone 13, there'll be an inventory card for the black one, an inventory card for the pink one, an inventory card for the blue one, the green one, etc. What you might start to sort of see as a customer, because that's your life experience at this point, is go, well, hang on, like, why are there 2 cost prices here? There's one for $300 and some for $280. When I check online and I go and buy these, they actually cost me $1,300, $1,400. It doesn't matter whether it's green, pink, midnight black or blue. It doesn't matter. They're all the same price. That's because you're thinking of it as a customer. That's the price the customer pays. So if we take JB Hi-Fi, that's our business. Here's the customer. She's paying $1,349. What we're interested in with these inventory cards is not the sales price. We want the cost price. And let's just say Apple, it's making up some dates here, on May the 7th, said to JB Hi-Fi, we will sell you iPhones for $300. And there you go. That's how we got these ones. But then prices change. We might buy more in bulk, so Apple gives us a better price, or could be inflation or economic events, whatever. But the point is, Apple might change the price, and they might say on May 19th, the price is now $280. So you can buy a batch of iPhones for $280, and that's how we got those ones. The use of inventory cards, just some advantages. It's going to be very similar to our perpetual inventory system advantages, because they're kind of similar, like as in inventory cards are part of the perpetual system, but we'll say we've got greater inventory control. We can check the inventory card on the computer at any time and find out how many we have. And therefore we can make better decisions about when to reorder and in what quantity. The main thing is we can check these inventory cards at any time to identify slow-moving and fast-moving inventory, which items sell well, and we should get more of those, and which items don't sell. We should stop selling those. And lastly, reordering is very efficient because we can set a reorder point, say 5 units, and when the balance gets down to that, the computer or the inventory card automatically orders more. It's got one last thing to figure out though. Let's just take this inventory card here. It says the balance at May 31st of the iPhone 13. We've got 5 at 300, 10 at 280. Well, what if we sell 6 today? How do we value that? Do we sort of go, because we've got 5 at 300 here and 10 at 280 there, do we say, the cost of these, all 6 are 300? Well, that can't be right because we've only got 5. All 6 cost 280? Well, maybe we've got 10 of those. Should we do 3 of each? Or should we do 5 of the 300 or 1 and 1 of the 280? Well, there's no right answer here because it's going to come down to what method of inventory valuation you use, and we need to learn 2. So we've got to learn the following 2, and that's what will take up most of the rest of our time this chapter, is learning either the system called the identified cost method or the first in, first out method, which we'll abbreviate, we'll call that FIFO.